Hi everyone and welcome to this recording. In this recording we are going to discuss individual insurance contract. So specifically it means life insurance contracts, and then we'll talk about term insurance. Okay, so let's start with it. So the introduction of this topic: throughout history there are numerous examples of drawing small proportional amount of assets of all to prevent the financial ruin of an unfortunate individuals. So what happens? What is the concept of life insurance? Lot of people come together, they pool small amount of money into an insurance pool, and whoever is the unfortunate person who loses a life, right, is paid out from that pool. So we know this concept as the basic principle of insurance. A small amount of money collected from many can be used to alleviate the financial distress of a few, provided that system for predicting the chance of losses is reasonable to the circumstance. So what do insurance companies try to do? They collect premiums based on chance of loss. So what is the probability of loss is the basis of collecting premiums. The purchase of life insurance policy results in the transfer of true risk of loss from an individual to an insurance carrier, and the insurance company uses the science to minimize the overall risk associated with issuance of life insurance contract. So in a life insurance contract, when you pay premium, you're transferring the risk of loss of life to the insurance company. So if something happens, then the insurance company is going to pay for that loss. Now there are different parties to the contract. There is insurer or carrier, right? So let's discuss what that is. So life insurance carriers are owned in two different ways. So the insurance companies, when they are formed, they can either form as a stock company. Most of the time you will see that they are listed on the stock exchanges, and then there are mutual companies, right? Some credit unions and stuff are formed as a mutual company. So what is a stock company? The insurance company issues share capital similar to other corporations. In Canada, the federal insurance law requires that a stock-based insurance carriers have two classes of directors, where one class is elected by the shareholders while other classes is elected by the policy holders who own participating policies, which is a type of an insurance policy whereby the policy owner is entitled to participate in the profits of the company. So most of the insurance companies in Canada, you will find it they are established as a stock company. Insurance company is a complicated matter because shareholders who own stocks of an insurance company, they are also entitled to some profits from the insurance company, but insurance companies can issue participating policy, which we are going to discuss in the future discussions. But a participating policy is a policy in which the policy holder, the person who is buying that policy, gets right to the profits of the insurance company, shares the profits. So it becomes complicated. That's why two set of directors are established. One set of directors is for like the shareholders, one set of directors is for the policy holders. Then there is mutual company. The company is owned and operated by and for the benefit of the policy holders. Mutual insurance has no share capital and thus no shareholders to receive any profits. Profits are returned to the policy owner through dividends. With the mutual company, there is only one class of directors, those elected by the policy owner. Some credit unions are established as a mutual company. So policy owners are coming together, they are running the insurance company, and whatever is the profit of the insurance company is paid out as dividends to the policy owners. Now, who is a policy owner? Right, you might be wondering that. With a life insurance contract, the policy owner is the individual with whom the insurance carrier forms the contract. The policy owner has the right to name the beneficiary to receive the benefits specified under the terms of insurance contract. The policy owner has the authority to deal with the insurance policy in any way he or she chooses, unless he signs away some or all of his rights, and has the right to access the cash value in the policy or to borrow against the policy's cash value. So an insurance company signs a contract with the policy owner. Now, most of the time, policy owner and the life whose insurance policy owner and the person whose life is insured might be the same. So, example, I am buying insurance in my own name. So, in that case, policy owner is me, because the insurance company is forming a contract with me, and the life insurance is also in my name. Right, so life of me is being insured, but policy owner and the person whose life is insured can be different. For example, I can buy life insurance in my wife's name. So in that case, policy owner is me, the insurance company is forming a contract with me, but my wife's life is now insured, so it can be different. Ownership of a life insurance contract may be transferred through absolute assignment. So I can transfer the ownership of my life insurance contract to another person, who then becomes the owner of the policy with full authority. When the policy owner differs from the life insured, the policy owner has the right to name a successor or a contingent owner, who then becomes the new owner if the current owner dies before the life insured. So example, I buy life insurance in my wife's name, right? So I am the policy owner of that life insurance policy. In case, right, something happens to my wife, then, right, the payout from the insurance company will happen. But I am the policy owner, so I can make changes to that policy, right? Or I can use that policy to borrow if it is a cash value based or investment based policy. Now the problem is, if something happens to me, who will be the policy owner? That's a big question. So I can name my successor. So I can say, if something happens to me, my wife is the policy owner, right? So the rights to change the policy or rights to use the policy as a collateral to borrow money will be shifted to my wife. Life insured. Under the individual life insurance policy, the person whose life is insured is commonly referred to as life insured. The restrictions within Canada insurance law require that an individual have an insurable interest before a contract of insurance can be issued and become valid, right? So you can buy like insurance in your own life. You can also buy insurance wherever you have an insurable interest. Joint life. A policy where there is more than one life insured is referred to as joint life policy. So like example is joint last to die. So this is a policy whereby joint means two people or more people are insured in the same policy. Common case is husband and wife has a joint policy. So if it is a joint last to die policy, is husband and wife, both of them are insured, but the person, right, joint last to die means when both of them die, then the policy will pay out proceeds. So this policy is based on two or more lives, where the policy pays a death benefit upon the last death. So both of them need to die, right? In that case only the proceeds will be paid. Or it could be joint first to die. Joint first to die means again husband and wife having a joint policy. The first person to die, maybe the husband dies first, right? The policy will make out a payment. The policy is based on two or more lives, where the policy pays a death benefit upon the first death within the group of life insureds. Then when you are designating a beneficiary, that is, you are assigning a beneficiary, there is a concept of revocable versus irrevocable. There are two types of beneficiary designations available to the policy owner: Irrevocable means once you designate the beneficiary, you cannot change it. While the beneficiary remains alive, the policy owner may not alter or revoke the designation without the prior consent of the beneficiary. The policy owner's control over the policy is limited, and she requires the consent of an irrevocable beneficiary in order to do such thing as alter or revoke the beneficiary designation or surrender the policy. Revocable. Revocable means the policy owner retains the right to alter the beneficiary designation without obtaining the prior consent of the beneficiary. A revocable beneficiary has no legal rights to any proceeds or decisions regarding the policy until the death of the life insured. So simple, revocable means you cannot change it without the consent of the beneficiaries. Revocable means you don't need the consent. You can unilaterally change the beneficiaries. So designating a beneficiary. A named beneficiary. A policy owner has the opportunity to name a desired beneficiary in the insurance application, and this will appear on actual policy. Okay, the following are the advantages of naming a specific beneficiary to receive the insurance proceed. So as a policy owner, you have the opportunity to name a desired beneficiary in the insurance application. So when you sign the insurance application, they will give you who are the beneficiaries. You can name it. Okay. If you name the beneficiaries, there are advantages. The insurance money is paid directly to the beneficiary and does not form part of the estate. So if you have no beneficiaries in an insurance contract, all the proceeds will go into your estate. Then you have to pay estate taxes, then you have to the will decide the distribution. So it's a complicated process. So rather than going through the estate, right, it is way better that if insurance company is paid directly to the beneficiary, it doesn't go into the estate. Upon satisfactory proof of claim, the life insurance proceeds are paid promptly by the insurance carrier, which provides the beneficiary with a liquid asset. So this is also an advantage. The proceeds paid out under the life insurance policy are a private matter between the beneficiary and the insurance carrier. So when money is paid directly to the named beneficiary, it provides high degree of privacy, because if the assets flow into estate, then estate claims have to be are usually adjudicated by the courts, right, decided by the courts. So courts will know what's happening with personal assets. So it's not that private. So it's better, if you want privacy, then it's better to have beneficiaries. Upon the life insured's death, the named beneficiary is entitled to proceeds which are therefore protected from policy owner's creditor. So creditors get no right on those proceeds. If it flows to the estate, then creditors, if you have creditors, they get right to those proceeds. Unlike will, where other persons can contest the deceased wishes, the proceeds paid out to the named beneficiary are rarely subject to legal contest. So there are a lot of advantages, right? Main advantages, based on the last discussion, is creditors. If you have creditors, they cannot contest. Then the privacy is high, the efficiency is high. And finally, if you have relatives who do not agree with the beneficiaries, if it is going to a named beneficiary, there is very little that they can do. But if it goes to an estate, they can contest the estate, they can contest the will, right, in the court. So that becomes a issue. But sometimes having estate as a beneficiary is also something that you want to ponder on. What are the advantages? The payment of proceeds into estate can provide a liquid asset that facilitates payment of policy owners' debts and obligation, and can fund bequest, like charitable donations. So if you have taxes and debts you want to pay from insurance, it's better to move the proceeds of payment into an estate first, then pay debt and obligations from that. Administration of an estate in receipt of significant cash will be easier, more flexible, and may allow for retention of valued family or business assets that might otherwise need to be sold to raise cash. So this is also an advantage, that administration of an estate in receipt of significant cash will be easier. So the cash moves easier into an estate. It is more flexible, so you can pay debt, you can do bunch of other things, and may allow for retention, right? Because taxes can be paid, so you don't have to sell asset. Disadvantage: the potential for policy owners creditor to access the insured funds through the estate. The fact that, so this is a big problem, when you do not name a beneficiary, right, it goes into an estate. If it goes into an estate, if you have creditors, they can sue that estate and stake their claim. So this becomes a problem. The fact that assets passing through an estate, including life insurance proceeds, are subject to probate fee. That is the probate taxes I was talking about. It is fees basically. It is certain percentage that the courts will charge. Now, what happens if you have a minor as a beneficiary? Minors cannot provide a valid discharge to an insurance company. The policy owner can arrange for appointment of a trustee to assume control of life insurance proceeds on behalf of a minor child. So if you have a minor as a beneficiary, you need to assign someone as a trustee. So the funds will be in minor's name, but the trustee will be able to, right, arrange for the proceeds or manage the proceeds. There is also contingent beneficiary. Contingent beneficiary is entitled to the proceeds of the policy if the first beneficiary predeceased the life insured. Like if something happens to the first beneficiary and the first beneficiary is not there anymore, then the funds will move to the contingent beneficiary. Now, settlement options. Right, so there are different ways to get settlements from an insurance company. Most insurance policy proceeds are paid out as a lump sum amount to the beneficiary. However, insurance policy can also provide for different form of payments known as settlement options. They can include payment of a lump sum amount, so big amount paid as a settlement, or money can be held on deposit. So money is deposited into a certain fund, or money can be paid out as an annuity through installment. So rather than paying it in one go, it is paid, let's say, every year or every month to the owners. Especially useful if you have kids and stuff. It is better to pay money in monthly settlements rather than in one lump sum, because they might need ongoing help to proceed through their life. If settlement options are not pre-selected by the policy owner, the beneficiary has the option of selecting any of the settlement options offered in the insurance policy. Now, the next topic is, when you form an insurance contract, it can be void or voidable contract. So let's understand that. So what is a void contract? The contract is simply considered invalid and there is no opportunity for correction of an individual issue. Example, if you provide fraudulent medical evidence, the insurance company simply states that the contract is void. You cannot correct it. Then there is a voidable contract. There is a fault in the contract, but the fault can be corrected. For example, if you misstate age, it is a voidable contract. So there is a fault, but that fault can be corrected by the insurance company. Policy delivery, right? So what is policy delivery? It takes effect when the contract has been issued as applied for and when the first premium has been paid in full. It is possible to simply deliver the contract to the insured. Policy delivery means when does the policy start? When it is issued as applied, right? The premium is paid, then the policy starts. Or it can be when the first premium has not been paid, the policy will not take effect until the first premium is paid. So in insurance, premiums have to be paid in advance. So when you pay the premium, only then the policy starts. Okay. Now, when you form an insurance contract, there is recession rights, right? So recession rights, also known as a 10-day free lookup. It means when you get an insurance contract from the insurance company by paying the premium, right, you have 10 days free lookup. That is 10 days. Within 10 days you can cancel the insurance contract. If you cancel, you will be refunded the premium in entirety, right? So that is called as the 10-day free lookup. So this is a 10-day period during which the policy owner has the opportunity to cancel the policy and receive a full refund of any premiums paid. So whatever premiums you have paid, you get full refund. Then there is incontestability period. What an insurance contract becomes after the 2 years contestability period has expired. Incontestability means insurance company has 2 years, right, to cancel the policy or contest the policy. Contest means argue the policy, right, if they find some material like facts have been missing. For example, you forgot a medical report, or you forgot the date of a medical report, and it happens within the 2-year contestability period, then the insurance company can cancel your insurance policy or charge you higher premiums. But if that material fact, right, was missed by the insurance company for 2 years, then they cannot contest the policy based on that. Okay, so if you misstate the date of your medical report and that misstatement continues for 2 years, the insurance company did not realize, after 2 years they cannot cancel your policy based on that fact. Okay, so that's an incontestability period clause. That does not apply to fraud. If they detect fraud, they can cancel the policy whenever they want. Okay, misstatement of age. Special rules apply in situations where the correct age of life insured on the date of policy application exceeds the maximum age limit imposed by the carrier. Okay, so misstatement of age means if you are 26 years old, right, but in the policy you misstated that you're 25 years old, right, unless and until it is above the cancellation time period. For example, 65 years is cancellation period on most term policies. So then they will pay out your benefits, but they will pay out the benefits based on your correct age, right? So instead of paying benefits based on age of 25, right, they will pay reduced benefit based on the age of 26. So they reduce the benefits if the age is misstated. Okay, then most insurance policy have a grace period. What is a grace period? It is the period of time, usually 30 days, after which the premium payment has been missed. The insurance coverage remains in force, although the policy will be considered in an overdue position. If the premium remains unpaid after the grace period, the policy is lapsed and is no longer in effect. So grace period, simple to understand. Usually they give a 30-day period, right? If you miss any premium, monthly premium, let's say, you get a 30-day period. If you do not pay the premium within that period, the policy gets voided. Policy reinstatement. If a policy lapses for non-payment of premium, the insured has the right to request that the policy be reinstated at any time during the 2-year period immediately following the date of policy lapse. Along with the request for reinstatement, the insured must pay back premiums and other indebtedness on the policy. So you have to pay back all the premiums that you have missed and provide evidence of good health and insurability of the life insured. The criteria for reinstatement of the policy differs by insurance carrier. So if you miss out premiums and you want to restart the policy, right? Because now you have money to do that. Then you have to pay out the missed premiums and provide evidence that you're in good health and the company wants to insure you. Then you can continue with the policy. Then most insurance contracts have suicide clause. Commonly, individual life insurance policies include an exclusion period for death by suicide, typically 1 or 2 years during the initial period, after which the insurance policy is first issued. This is done to discourage the purchase of a life insurance policy in anticipation of committing suicide. So most insurance policies will not cover you for suicide, right, in the first 1 or 2 years, after which even death by suicide is also covered. Now, insurance premiums are based on life expectancy. So you can see the life expectancy of both males and females is steadily going up, right? So the chance of death for males and females has been steadily going down, but females have a way higher life expectancy than men. Okay, that's why the premiums for women are usually less in life insurance. Okay, so we discussed that mortality between males and females are different. So given that the term mortality, just a second, my cursor went by. So given that the term mortality refers to that, the phrase mortality rate is used to describe the rate of death expected in the upcoming year based on prevailing age. The mortality rates can be measured based on wide set of criteria, which normally includes age, sex, smoking status, etc. So premium for an insurance policy is contracted using this formula. The three main factors used in pricing of an insurance product are mortality cost, the carrier's operating expenses, and the expected investment returns on the premiums or contributions into the plan. So premiums that you pay is mortality cost, the cost associated with death and the payment of that death, operating expenses for the insurance company, which includes a small profit margin, minus the investment return that your premiums are generating, which you are entitled to. So if you're entitled to certain investment returns based on your premiums, then that is subtracted. Now, most policies have two kinds of premium payments. In one case, the premiums keep on going up as your age increases. In the second case, there are certain insurance policies in which the premiums are leveled. Leveled means, right, initially they are little bit higher than what your age recommends, but like later on they are lower than what your age would recommend. So they are leveled off. So premiums again depend on age. On an average, the risk of death increases the older one becomes. So as an individual ages, the probability of death in the next year increases. So as you age, your insurance premium will go up. Gender. Since the statistics indicate on an average, men are not expected to live as long as the women. So males have a higher mortality cost than females. Smoking status. Since smokers are likely to contract an illness, they pay higher premiums, this is key important point. Smokers have premiums which are 40% higher than non-smokers. Each insurance carrier has its own definition of what constitutes a smoker. Some may be more lenient when it comes to cigars, for example. Then, premiums also depend on rating. When an insurance policy is issued based on standard rates, this suggests that life insurance is assessed as being similar to an average or expected person. So where standard is expressed as 100%. But certain individuals are not standard. So they have additional risk factors. So those risk factors will change their rating. Risk factor determines an individual's rating. So for example, a policy has a 150% rating would be one where the insurance carrier is willing to issue the contract but at a charge based on 150% of standard premium. It could be because you are in a very riskier profession. Maybe you're a professional skydiver. Then your insurance rating is higher, so they will charge you additional premiums. Uninsurable, the term is used where insured's health or other factors considered material to the underwriting is just to be at a level of risk higher than the insurance company is willing to accept. So let's say a person is really sick, really struggling, they might not give like insurance to them. Okay, then preferred rates. Some insurance carriers have developed a new rating approach to the premium where they reward individuals whose personal risk profile is viewed as being superior to the expected average. Right? So some insurance carriers have developed a new rating approach to the premiums, means certain individuals, if they are really healthy, you might get a preferred rate. So it is little bit lower than what an average person gets. For some products, the carrier is willing to offer the preferred rating where the individual pays a premium that is less than that charged for a standard profile. These enhanced premium structures are commonly referred to as preferred premiums or rates. Now, underwriting means, right, how much premium are they charging and if they are going to provide you insurance. It depends on health. The life insured's current health and physical condition as well as health history is a significant consideration in underwriting process. The life insured's family health history is also a big consideration. Okay, so how healthy you are, right, that determines like to a large extent of, right, how much are they going to provide you the insurance and how much premiums are they going to charge you. Character and occupations both are considered in the underwriting process. Occupation, where an individual's occupation places the life insured in a position of risk greater than the average, it may cause the carrier to adjust the insurance premium to reflect the increased risk or may contribute to carrier's decision that the risk is uninsurable. So sometimes if you are in a very risky occupation, then the insurance company might deny you to give you insurance. Okay. Character, if there is a pattern of behavior that indicate an increased risk for a carrier, such as history of speeding while driving, that would be a consideration that is acceptable and pricing of the risk. So sometimes you may be in a stable job but you have very risky behaviors. You have a lot of like parking tickets or a lot of unreliability. In that case, they might charge you extra. Now, when you buy an insurance contract, you will always have discussions about riders with the insurance agents. So what are riders? Riders are add-ons that you can purchase in addition to the original contract. So a rider is an endorsement or a supplement that is added to the basic insurance policy to increase the features under the policy as a part of an overall plan design. Some of the common riders are waiver of premium, accidental death and disbursement, guaranteed insurability, cost of living adjustments, and term riders, additional insurance, right, on top of permanent. So we will discuss these riders as the PowerPoint proceeds. So they are mentioned in future slides. So some terms that you have to be aware of. What is face amount? The face amount in an insurance contract is the stated amount of money on the face of the policy that is paid in the event of death. So in case of death, this is the amount that is going to be paid out. Beneficiary, the beneficiary of the insurance policy is the person named in the policy as the individual who is going to receive the life insurance proceed upon death of an insured of the life insured. So if something happens to the person whose life is insured, the beneficiary gets the payment. Adjusted cost basis, the adjusted cost basis of a life insurance policy. This is important for tax calculations, which we are going to see in the future slides. Adjusted cost basis of a life insurance policy is the sum of all the premiums paid less the sum of net cost of pure insurance. So adjusted cost basis is the premium in excess to cost of insurance that you are paying. So generally happens in the case of investment kind of policies, where the premium you're paying is way higher than the cost of insurance. So the excess premium gets invested. So that excess premium is helpful to calculate adjusted cost of basis. Now there are certain exempt and non-exempt policy. So what is an exempt policy? Exempt policy is one designed primarily to provide life insurance protection, allows for tax deferred growth until the policy is terminated. So in an exempt policy, you do not have to worry about taxes until the policy is terminated, that is, the policy pays out. Okay, non-exempt policy, one that does not meet the required definition of exempt as established under the Act, and such it is deemed to be designated primary as an investment and not as a life insurance policy. This is taxed on an annual basis. So on an annual basis, you have to worry about how much interest it is generating, what kind of dividend it is paying. If there is any capital gains, you have to worry about that. Most policies are exempt policies, right, in which the tax payment is deferred. Then there are two kinds of policies, temporary and permanent. Okay, permanent life insurance means the life insurance will pay if the person dies. Okay, whenever the person permanent life insurance is a policy which pays when the person dies. The death can happen now in the next 1 year, or death can happen like 65 years from now. It will still pay the benefit. Temporary means the insurance policy will pay if the person dies within a certain time frame. So for example, if you buy it for 5 years, then if the death happens in those 5 years, the payment occurs. Otherwise, the payment will not occur after that period. So an individual's need for insurance may be short-term or perhaps temporary, where the need is for a specific period of time. Example, mortgage. If you have a 10-year mortgage, you might want to get yourself insured for the mortgage amount for those 10 years, after which you might not need the insurance to cover the mortgage. In this case, it makes perfect sense to purchase a product designed specifically to address temporary or short-term needs of insurance, such as term insurance. Permanent insurance is the reverse of that. It is the coverage designed to provide insurance coverage throughout the insured's lifetime. So whenever death happens, the payment will occur, such as whole life policies, universal policies, and term to 100 policies, which we'll discuss next. Okay, now in an insurance contract, you might also have some living benefits. So what are living benefits? If you get terminally ill is there is guarantee that the death is going to happen, right? Then you may access some of the benefits of life insurance, some money of life insurance before the death happens. So when an individual is diagnosed with terminal illness, it is becoming increasingly common for insurance carriers to allow a life insured who is terminally ill means death is certain, to receive partial prepayment of death benefits known as living benefits. This type of loan or advance is treated as an advance against the eventual payment of life insurance proceeds. Okay, so in the next bit of discussion, we are going to discuss term life insurance. Term life insurance is temporary life insurance. So the term life insurance provides life insurance coverage for a limited. Okay, so like we were discussing, term insurance is temporary insurance. So term insurance provides life insurance coverage for a limited period of time, which is reflected in the word term. The period of insurance coverage will vary, with contracts normally expiring at the maximum age of 65, 70, 85 or 75 to or 85. What does this mean? Term insurance is not indefinite insurance. Beyond the age of, let's say, 65 in most cases, the insurance company will not cover you. Okay, insurance company will not provide you insurance. The term insurance is type of insurance product developed to address the need that is temporary in nature, where there is no permanent need for life insurance coverage. There are a variety of different term insurance products on the market, some of which simply expire at the end of specified term and others can be renewed for multiple term. Now every term insurance product will have a benefit amount. So how much amount is going to be paid out, right, in case of death? With the purpose of providing insurance for temporary needs or for a specific period of time, the term insurance can be established with a fixed level of coverage throughout the term of the insurance contract, or it can be designated with a decreasing level of coverage, such as insurance designated to cover a mortgage throughout an individual's lifetime. So you can have the same amount, right, for the entire duration of the term. So let's say you buy a 10-year insurance with $1 million as the benefit amount. So $1 million will be paid throughout the term. Or you can have a term insurance in which the benefit amount goes low as you age. Then renewable. Some of the common forms of term insurance include 1 year annual renewable. So after every 1 year the premiums will change and the insurance company will decide whether they want to continue with you or not. 5-year term, 10-year term, 20-year term. So insurance company reevaluates the premiums and whether they want to continue with you or not after these periods, 5-year, 10-year or 20-year. Term to 65, where premium is set at the point of issue and remains constant until the term age, that is 65. Okay, it is common for 1, 5 and 10 and 20-year term insurance product to offer the insured the opportunity to renew the policy at the end of each successive term up to the maximum age of the life insurance, usually 65. That is, after the term gets over, right, you can discuss with the insurance company again whether you want to renew the term or not. So it looks something like this. So let's say you get a 5-year term insurance, right, and you want to renew it up to the age of 65. So after every 5 year, right, the insurance company will usually increase your premium because your age has increased. So it looks something like this. 5-year gets over, premium increase. 5-year gets over, premium increase. 5-year gets over, premium increase, right? Continues till the age of 65, beyond which term insurance is usually not given out by the insurance companies. Then certain term insurance products are convertible. So convertible feature means where the insured is given the opportunity to convert the term insurance product to a permanent insurance product offered through the issuing insurance carrier without the need to provide evidence of insurability, that is, your health is not a consideration. You can convert the term policy if you have this feature in it to a permanent insurance policy. Of course, the premiums will increase, but you do not have to do health checkups. For affordability reason, an individual might initially purchase the term insurance to cover the financial needs, knowing at a future point he intends to convert the term insurance into a permanent policy. Why affordability is a big concern? Permanent policies are extremely costly. Term policies are very, very cheap. So a person might buy a term policy right now because he can't afford permanent insurance, but later on, as he starts earning more, he might convert it to a permanent policy. What happens on policy expiration? With the term in life insurance, the insurer carriers normally sets a maximum age, usually 65, with regards to the life insured, after which the policy terminates with no opportunity to renew. If the need for insurance coverage remains as the policy expiration date approaches, conversion of a policy to permanent policy might be a wise consideration. Common ages are 65, 70, 75 and 85. Now, product pricing and premiums. With term insurance, the insurer carrier's premium schedule takes into consideration the insurer's carrier's mortality and expenses. So just mortality and expenses are consideration, right? It doesn't factor in investments and stuff. Generally, premiums for term life insurance are relatively low in the early years and increase throughout each successive renewal. And individuals may decide to pay monthly, quarterly or semi-annually depending upon which type of insurance carrier makes available. Okay, so you can pay monthly, annually or semi-annually. So that's it for this recording. In the next recording, we'll discuss permanent life insurance.